Hey there, everyone. Happy Wednesday. Happy hump day. It is Wednesday, May 14th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully rainy and gorgeously green Redmond, Washington. Seattle is known as the Emerald City, and this is one of those days where you realize why the green just kind of jumps off the landscape because there's a lot of trees and a lot of grass and a lot of wetness, and it all beautifully, works out. I did a long hike after the show yesterday. It was pretty awesome, about a 2.5 hour hike or so through the woods. It was not raining yesterday. That was the time to do it. So timing is everything in the markets and at the trailhead. So luckily, it looks like we timed out this week pretty well along those lines. End of the day, the S&P choppy, sloppy, sideways, noisy, upswings and downswings, cyclical movements, but no real directional sense through the day today. Overall, yesterday's big up move, sort of the big meal today, the digestion day, as the S&P essentially is unchanged, slightly higher, Dow slightly lower. The real action in growth with the NASDAQ composite up about 0.7%. Today, we'll look at the market averages. We'll look at how things played out. We'll look at commodities, in particular, gold having another rough day here. I still have a decent position in gold. I'm getting less excited about that decent size position. I'm feeling like making it a little less decent size here, and I'll probably start making some changes this week. Given the short-term breakdown, basically gold making a new swing low. If you look at the GLD, still not the end of the world, but feeling some short-term weakness. We'll also look at the charts in the technology space. Some other areas of the market showing strength, right? I'm not struggling to find stocks that look fairly constructive, and that's really been the case for a while now, right? Even through the turbulent period in February, March, April, there were charts that were actually still doing quite well, like tobacco stocks, grocery stores as examples. Now it's just a bit of a rotation, right, into other areas of the market really starting to emerge and do well. But that is the process of technical analysis. It's find an approach that works, apply it consistency, wash, rinse, repeat, and then keep doing that every day, every week. And that's how hopefully we continue to rotate out of things that are not working and into things that are working. We remain with things that are working as long as they continue to do so. And then we take action when the chart tells you it's time. Let's try to put some details behind everything I just said in that introduction. At the end, of course, I will take some questions, and I appreciate you guys tuning in live on Facebook, LinkedIn, YouTube, and X. Drop questions as we go. We'll get to a couple questions at the end of the broadcast, and anything we don't get to, we'll put in the mailbag. Planning an old mailbag episode on Friday. All right, so here's the chart. Right, yesterday the S&P obviously a big acceleration out of the open. Weaker close, but briefly tipped above 5,900. Today, basically choppy. We had a couple just quick spurts above 5,900, but each of those ended up being sold off. We didn't get much below 58.75. So in the end, fairly narrow range to the day today. The VIX sort of up in the 25, 30, 35 range tells you we should have big percentage swings. A VIX down below 20, which is where we're at now, tells you we should not have as many big swings. And today sort of fitting that low VIX type of environment. So the S&P finished today, call it 58.92 and change. And again, that's up 6 points from yesterday. That's a tiny less than about 0.1%. The NASDAQ composite up about 0.7%, so the best performer there. The Dow down slightly to 42,050 with a little bit extra. The VIX moving higher, but not by much, about 0.4 points. So the VIX still below 20. Mid caps, small caps, all in the red, and the S&P 600 small cap ETF down the most, down about 1% today. So, again, no real change to the general theme we've been observing here in recent weeks, with growth back over value, with the NASDAQ over the Dow, and today kind of continuing. Looking at interest rates, we can see bonds continue to rotate lower. So one of the themes we've been observing here in the last week, weaker bonds, stronger stocks, sort of implies a rotation, a reallocation away from the relative safety of bonds and into risky assets like equities and other things. The TLT, which is a treasury ETF that we track, down about 2/3%. across the curve, 5-year, 10-year, 30-year points all moving higher. The 10-year points currently around 453. The long bond yield not quite to 5%, but very close to peaking above there. And the dollar slightly higher. No big change in the dollar from yesterday's close. A lot of red on the page of commodities, as I mentioned in the introduction. The chart of gold is starting, again, but based on my, kind of traditional methodology, it's still in good shape on the medium term and long term timeframes. It's the tactical time frame that is shown a pretty good downside reversal. The GLD down 2.1% today. Silver prices down 2.3%. Copper, crude oil, nat gas, everything in the red today in commodity land. Cryptocurrency is not particularly great as well. Bitcoin got as high as 105,000, currently down to around 103,500 and change. That's down about 0.5%. Ether prices down just over 3%. And you can see the rest of the top 10 coins all in the red. Looking at the 11 S&P sectors, some familiar ETFs at the top of the list here, and it's the FANG sectors. The MAG 7 back in the driver's seat. The XLK up 0.2%. The communications services sector, number 2, up 0.5%. Consumer discretionary down up 0.4%. All the other of the 11 S&P sectors, so that's the other 8 sectors, all in the red today. And that is a theme we're also going to talk about today. Someone mentioned in the chat that the breadth was pretty bad today. That is 100% true. Breadth not great. Now, the breadth overall has been quite strong coming off of the April low, increasingly so here as we've gotten into the month of May. But sector breadth, not great today. The only 3 sectors up, the FANG sectors. The good news for the markets is those are big sectors that represent a lot of market cap. As a result, the index is doing quite well, and this is why the NASDAQ has outperformed. But if you look down, healthcare continuing to deteriorate. Hopefully, you've heard the very clear message. That is not a great sector. There are some random names doing quite well. So one of the things I like to do when you see something like healthcare down a lot, look for stocks within the healthcare space making new swing highs. So I was scanning earlier for stocks making new 3-month highs in the healthcare sectors. They're there. It's not all of them, and it's certainly not the pharmaceutical names, but it's other things like services and devices. Those are the ones that are looking a little bit better. And I'll share with you one of those that we found this morning. Materials, number 2 from the bottom, and real estate, number 3. So, defensive sectors not necessarily all at the bottom of the list. For example, utilities kind of in the middle of the pack today. But I think one of the stories when you look at today, and again, all we're doing in this environment is sort of assessing the primary trend, which certainly seems positive at this point, and then looking for signs that that positive trend is no longer in effect. And I would say, this is one of those examples that doesn't feel great to me, where it's less of a broad advance and more of a narrow advance with the 3 FANG sectors doing well and everything else in the red. Here's the breadth that I was talking about, the New York Composite breadth in the top panel, 2 stocks down for every 1 that was up. And so quite a bit of distribution there. Looking at the S&P breadth, 70% down, 29% up. So, and the small cap breadth, really bad, 80%. So, sort of a 4-to-1 ratio of stocks down versus up. So by any definition, the breadth has been pretty positive here in recent weeks. This is not what we saw today. Today was sort of weaker breadth. Now, one day doesn't make a trend, and obviously the S&P going sideways is not that bad of a thing. And you could argue, regardless of what your market outlook is at this particular point, after the run that we've had, a decent pullback, some sort of short-term downswing could arguably be a wonderful way to sort of clear things out, take some profits, reset, and then set the stage for another big advance higher if that's what's going to come. But days like this, a little concerning, right? When you see weaker breadth in the face of the broad advances here. Looking at the Magnificent 7 stocks, as I mentioned, these were the sectors that were doing quite well today, but we'll start at the bottom here. Amazon, Apple, Broadcom, all down. Not by much. So Amazon was only down 0.5%. That's not that bad. But Apple and Amazon are 2 of the particular names that have been struggling to sort of follow through to the upside. Amazon pushing above the 200-day, Apple not quite getting it done. Alphabet, which has been one struggling the most, retesting those swing highs from the end of April, right around 165 to 167. Tesla, Nvidia continuing to push higher, right? So semiconductors generally pretty good day today. Nvidia and Tesla both up over 4% today. So those names within the Magnificent Seven that have started to emerge in the last week or two really continuing to push to the upside. Despite the market looking very different today and the breadth looking weaker today, those names continuing to work quite well. So it tells you where there's optimism, arguably sustained optimism, and certainly optimism of further upside to be had here. All right, let's look at the market carpet. This is a heat map style visualization. And I'll remind you as I bring this up, by the way, latest episode of the Market Misbehavior podcast just dropped, and it was really, really good. Last two episodes have been fantastic. I humbly would propose, and it's not about me, although hopefully my questions were good. It's more about the guests that were really knowledgeable and thoughtful. Beginning of this week, we published our conversation with Urian Timmer. Urian's the director of global macro at Fidelity, who I worked with when I was there off and on in different capacities, but really enjoyed his update on what we're seeing about all things macro. And then earlier today, we published our latest episode with Nick Raish. And Nick is the founder and CEO of the Earnings Scout based in Northeast Ohio. Really has a unique way of looking at earnings data. He started, working for institutional investors and found sort of a secret sauce of how to look at earnings in a way that he found other larger firms were not doing. He's turned it into a fantastic, successful standalone business. But we talked about what most investors get wrong about earnings and why they're often surprised when there's an earnings surprise or some movement in earnings estimates and the stock doesn't do what you think. And he has found the way to look at the rate of change of estimate revisions as the most important indicator for stock prices going forward. We talked a lot about the relationship between price and earnings. It was really, really well done, I think, from his side. So I hope you can check that out. Both of those on our YouTube channel with lots of great visual aids to go along with the discussion. All right, the heat map, again, is sort of this depressing center to the market carpet in the last couple of days, last couple of weeks, with healthcare getting absolutely clobbered. Obviously, some regulatory news weighing on those names pretty good. And it's from, the big pharmaceutical names like an Eli Lilly getting pushed down pretty aggressively. A number of biotech names like Gilead taking it pretty hard, and other names within healthcare as well. Now, if you look, there are random things that are green today, and that's what I found is sort of there are these little diamonds in the rough in a tough sector. There are often things that are actually doing quite well. You just have to scan for them, and that's where I found that scanning tools like I use on stock charts and I've used on Optima and Bloomberg and other Market Smith, which is now Market Pulse, right? I think. Those kind of things. Scanning tools are so helpful. You see a sector that's weak. Show me things in that weak sector that are doing much better than average, and that can be how you identify some opportunities. Maybe uncover some names with some upside potential. So the general weakness in healthcare continuing to be a real factor, and that's the type of thing I avoid until there's not as much red as I see today. Within consumer discretionary, take a note at home builders. You can see Lennar, DHI, which is DR Horton, Pulte Homes, NVR, all in the red today. In some cases, quite a bit, right? DR Horton down 3.5%. Now, these arguably have not been great charts, and these are ones that were in primary downtrends well before the February market peak, right? So Pulte Homes actually topped out in October of last year and was trending lower going into the end of last year, and it's just never really recovered from there. We did push above $100 a share, but again, not really following through yet above those highs from the first quarter. So I'm not a fan of that space at the moment. In the upper left corner, look at the bright green in NVIDIA and AMD. So semiconductors generally pretty good. Dell pushing above $100 a share, which is kind of interesting. Super Microcomputer was the best performer in the S&P today, up over 15%. Enphase Energy, which has not been a fantastic chart, up about 5+% as well. The things that were down in technology, it's a bunch of random things like Microchip, which is just pulling back after a nice run above 60. It's Intel, which is kind of like an outlier within the semiconductor space, very different than most of the semiconductor charts, generally speaking, down almost 5% today. But again, I mean, the concentration of green colors, certainly in technology. But here's the thing, right? If you mentally block out NVIDIA, maybe AMD, Tesla, and Alphabet. Not a great day, right? And that's the thing I guess that I'm sort of my takeaway looking at the heat map today. You see the benchmark, you see the Nasdaq up the way it was, and you think, wow, this is probably a pretty decent day for growth. I mean, not great. I mean, okay, but right. I mean, there's more of a mixed sort of modeled appearance to this heat map. This was not a everything up kind of day, which we've seen certainly in recent days and recent weeks. This is more of a questionable uptrend kind of day. Final thing that I would point out is look at some of the green that you see in the financial sector. A lot of these names obviously sold off pretty aggressively into the April low. A lot of these recovering quite well, like Morgan Stanley, Goldman Sachs, Bank of America, JP Morgan, all of those sort of pushing above their March swing highs and accelerating to the upside. The question for a lot of those charts is what they do relative to those all-time highs from the first quarter, and whether there's enough momentum left to propel above there. But certainly impressive runs here in the last 4 weeks or so. All right, that's my sort of general assessment of the heat map. Shall we get to the charts and see how things played out today? So the S&P, of course, continuing to move to the upside. The S&P for now demonstrating a gap and run pattern. It's what I call sort of a gap higher, and then you see additional movements after a price gap. I think that those next couple of days are crucial, because after you have a gap higher in any chart, right, one of two things happen, because there's obviously been a reset from day one to day two, and either there's additional optimism with people willing to pay a premium for whatever was trading a lot lower in the previous session, but still see enough optimism or enough value to continue to accumulate even after the price has been marked up, right? Imagine like you go to the store and the box of cereal is 20% higher, but you still feel like it's worth buying the cereal, as opposed to, oh, that sucks, I'm going to go buy the generic brand or something like that. This tells you people are still buying the premium cereal. I don't know if that's a great analogy for all of you, but that's where I'm at with school-age kids. Cereal hits home for me, so that's how I would say it, right? So, I mean, it's sort of like things have been marked up. Are people still willing to accumulate it? And the answer is they are. What you don't want to see is a gap higher and then a rotation lower, because that becomes what's called, what technical analysts would call an exhaustion gap. At the end of a big move, you often have that last gap higher where it's like everyone that's going to buy has now bought, and there's no buyers left to propel things higher. Tom DeMark, one of my mentors, would call that an exhaustion in buyers. He has indicators designed to try to identify those things. But for now, the S&P continuing to run higher. We have that red shaded area kind of around surrounding the 5750 level, surrounding the 200-day moving average. That's based on the price gap that was created from Friday of last week, really Thursday of last week into Monday of this week. It also includes this swing high from late March. I think overall, as long as the S&P holds that shaded area on a pullback, it's a pretty good chart. We fail to hold that, I think you're back to a yellow light stoplight style, and we need to start thinking about further downside. But certainly, I think this makes sense to be thinking of the market as innocent until proven guilty. Here's the stoplight that I was talking about, and again, just sort of putting things. I'm obviously a big fan of visual representations of the markets, which is why I sort of got into technical analysis. I love the way that you could look at things visually and have it tell the story. I think just thinking of things very straightforward, right? Below 5,500, you're pretty defensive. Between 5,500 and 5,750, we're in sort of neutral territory where you kind of take negative bets off. We get above 5,750, you reinitiate on the long side. That's kind of how I've been trying to follow this market, and that's where I'm at right now, which basically means there's some room here. There's going to be normal volatility, normal noise. That's still okay. But anytime we break that, I think I'm not the only one that'll start thinking about downside potential. I just want to talk about breadth. Obviously, breadth today, not particularly great, but the overall trend in breadth over the last 4 weeks has been quite strong, right? The breadth was very bombed out at the April low, and I'm 100% sure as I debrief, later this year and look back at this period and grade myself on how I navigated it, probably not being as optimistic given the very negative breadth, I think is a great lesson learned here, right? When the breadth indicators get that negative, you really have to start thinking about upside reversals as a very real possibility, which is how things have really played out here. The bullish percent index on the S&P 500 is the first panel below. The bottom panel is the bullish percent index on the NASDAQ 100. And if you haven't heard me talk about those before, those are breadth indicators based on point and figure charts. It's a classic charting methodology that was really done by hand on graph paper, easy to calculate every day and easily to just define charts as in bullish or bearish trends at any given moment. And this basically tells you the percent of stocks in the S&P 500 or in the NASDAQ 100 that are, generating a buy signal on their point and figure charts. You can see as of today's close, 75% of the S&P are in a bullish point and figure chart, 83% of the NASDAQ 100 in a bullish point and figure chart. Well, those are pretty constructive numbers. And I would say, while that's very good right now, and it is, what I'm always looking for is for that to change. Looking for divergences like we saw going into December of last year, with lower peaks in the bullish percent index as the S&P was making a new high going into year end. Just looking for an exit from that overbought condition, which often indicates some sort of pullback, and just looking for tactical pullbacks within the uptrend. But I also have to remember, and the reason why I want to have this chart is two things. Number one, we're at an extreme bullish breadth reading, which means at some point it comes out of that bullish breadth reading. That's always like a red flag to just be vigilant and look for some sort of pullback. But also remember that in the beginning of new uptrend phases, the breadth often becomes quite strong. And that doesn't necessarily mean we're at the end of the move. That actually could mean we're at the beginning of something. This is what's essentially called the breadth thrust. We've highlighted the Zweig breadth thrust. We've highlighted a lot of different breadth thrusts coming out of the April lows, and we've covered those, indicating that the breadth went from very negative to very positive in a very short window of time. And the forward-looking returns, if you look back in history, are usually quite good. So it could be like a "you are here" type of period, that initial big breadth thrust before we pull higher. There are going to be plenty of dips along the way, and I think the challenge you and I and all other investors are going to be facing is at some point this market stops going essentially straight up. It starts pulling back. That's going to wake up all the bears who are probably hibernating and waiting for the next shoe to drop. And bulls will probably get pretty nervous very quickly as the uptrend starts to rotate lower. And I think that's going to be the next big market move that will challenge us all. Now, other things to look for besides extreme breadth rotating lower. And again, a day like today, 1 day's breadth, if that happens over subsequent session, you'll start to see longer term breadth indicators start to rotate lower. That would obviously be pretty concerning here. The McClellan oscillator has been positive since mid-April, really a week after that April market low. The McClellan oscillator went above zero, and except for 1 day, has remained above that zero line. That's bullish short-term breadth. In this case, it's telling you breadth conditions are great. You look for a break below that zero line. Hasn't happened today. Would need more days like today to rotate lower. Now, this isn't updated for today's close just yet. So once the closing data is processed, it's going to be lower than it is today, but I don't think it would be enough to go back below the zero line and generate essentially a sell signal. You can see like here what it looks like when the breadth is very, very positive and then finally breaks below the zero line. That tells you things may be rotating lower. So that's sort of a warning sign, a red flag I would be looking for. We haven't seen it yet. Also, things like the Chaikin money flow rotating from a position of accumulation to a position of distribution. When you look at the Chaikin money flow today, it's well above zero, and it has been for the last couple of weeks, which tells you we're in a period of accumulation. So that's good. And as long as that remains that case in that state, that tells you generally over a look back period, which is about a month of market data, there's more accumulation than distribution based on the methodology that the Mark Chaikin created here. A break below the zero line would be the warning that things are starting to get a little more worrisome. But for now, in good shape. Speaking of things starting to get a little more worrisome, gold. Now, to be clear, gold has not broken its 50-day moving average yet. The momentum in gold is still quite strong. So I'm not seeing like screaming sell signals like, this is something we want to avoid. But I'm seeing a lower low here, at least a swing low, right? So the tactical time frame under pressure here. So the way that I would generally thinking of this is the tactical time frame in a bit of a pullback. The medium term and long term time frames quite strong. So in this sort of environment, it really is the way that you, I think of this move it's all about your time frame, right? If you're a swing trader, you might interpret this as a breakdown that you want to avoid and get out of the way. If you're more of a long-term investor, maybe you treat pullbacks as pullback opportunities, and you're okay taking some short-term pain for the opportunity for long-term gain. From a technical perspective, for now, I feel like this is bending but not broken just yet. We've broken the short-term swing low. We're holding the 50-day. The last time we had a pullback like this, we did hold the 50-day. We'll see if that holds. The RSI is right at 40. The RSI breaks below 40. Gold breaks its 50-day. I'll probably start lightening up on a position that I have in the GLD and IAU. For now, I'm sort of holding steady. Now, the strength today is driven by the strength in charts like NVIDIA, charts like Tesla, having upside moves. NVIDIA accelerated to the 200-day moving average, gapped above it yesterday, continued higher today. NVIDIA is overbought, and that on its own is not any reason to sell anything. I've found the RSI getting out of the overbought region is where you want to start to question whether you want to, to take profits or just how do you interpret a potential pullback. On any of these charts, though, the 200-day is just a beautiful kind of natural built-in stop. If I'm buying NVIDIA today, which I'm not, I would say, all right, there's my long position. 125 is my stop, right? Because as long as we hold the 200-day, that's just kind of normal chop. We break the 200-day, that tells me that could be the beginning of something more significant, and I probably want to avoid it. For now, we'll continue to watch it pushing higher. Alphabet has been one of the notable laggards within the Magnificent Seven basket of stocks, while other names have propelled higher, like Meta, NVIDIA that we've shown. Alphabet is one of the few remaining below the 200-day moving average, and I would say, looking for a move above the 200-day could be quite encouraging. It just hasn't happened yet. We're actually right up against Fibonacci support. This is a resistance. This is the 38.2% retracement. If you take the February peak, the early April low, we can see 38.2% of the way is right around 165 and change. That was almost exactly where we had the late April peak. Today, we're trading right back up to that level. I think the chart above that 38.2% level suggests a move above the 200-day, maybe a move up to around 180, 182. That would be the next upside objective, I would say, based on what we've seen so far. McDonald's breaking down, right? McDonald's looks like some other charts that are not necessarily broken yet, but certainly not in a resilient uptrend phase, right? You look at like this kind of period where we're making higher highs and higher lows. Here, we're actually languishing below the March peak. We're not really near the lows. We're not really near the 200-day moving average. We're sort of in a consolidation phase. What's interesting about a chart of Microsoft that I wanted to share with you, if you look over here, right, we sort of gapped higher from 295 to 300. That was there, which was, I think that was earnings, I want to say, right? The beginning of February, if I remember right. We kind of gapped higher there, traded up to almost 330, but then came back down. Keep your eye on that gap and the upper end of the lower end of the gap, right around 295. That was the support in March. That was the support in April. That's now the 200-day. So I think on the chart of McDonald's, on the longer term time frame, I think holding that is pretty good. On more of a short term time frame, that's where I probably look for betting on support. Right, this is where the stock has bottomed out. If we hit the 200-day and those support levels, that's where you bet on a counter trend move to the upside. Could be an interesting way to play McDonald's. The momentum has been fairly neutral on that chart, by the way. Here's Microchip Technologies trading up to what we call a confluence of resistance. Semiconductors have been quite well, while charts like have been very good. While charts like NVIDIA have broken above the 200-day and continued, charts like Microchip are actually holding the 200-day from below. So we've got a confluence of resistance, here. So at this point, if you're not in the name, I'm probably waiting, because this is kind of where a chart like this often pulls back as we're testing a February peak and testing the 200-day. If, though, we get above 65, which is where I'll set an alert as soon as we're done, that is where a chart like Microchip tells you there's probably more upside to be had. For now, I think it's sort of a wait-and-see moment. There are some charts breaking down. Within the financial sector, industrials have been one of the better places to be. Look at the relative strength in Willis Towers Watson from like July of last year to April of this year, just uptrend. And as the market was tanking in February, March into April, this is a stock that actually was making a new high or testing a new high at the end of March. It did pull back, and that subsequent rally around 330 has failed. Now we're back to the lower end of the range. The momentum is more negative. The relative strength is underwhelming. We're pushing below the 200-day moving average. I think clearing those lows suggests much further downside. This is the type of chart I'd be waiting to see if that 200-day can be recovered. The story of this market, though, generally, it's charts like NVIDIA and Tesla. It's semiconductor names. It's technology names like ServiceNow. Look at the gap to the 200-day moving average that was on their Q1 earnings at the end of April. From there, additional buyers coming in, pushing the market to the upside. The stock's now overbought, and what you look for is this sort of pullback phase. And I wanted to highlight, this is one of those, as it becomes overbought after that gap and run, I'm probably not thinking of today as a perfect entry point. I'm ideally looking for this sort of pullback, one of these pullbacks to an ascending 50-day moving average, to the RSI down in the 40-50 range. That can be a better entry point, buying on the dips on the way up as opposed to buying on the peaks on the way up. This feels like one of the peaks on the way up. We'll see if that plays out, but that's how I would interpret that chart here. And then within the healthcare sector, I mentioned doing a scan for stocks making new 3-month highs. Look at what pops up. Charts like HCA. Don't think of healthcare. What I would encourage you to do, don't think of healthcare as one big group of stocks. They are similar in that they're all related to the healthcare industry, but there's some different themes happening within the healthcare sector, particularly healthcare providers like HCA Healthcare, not affected as much by the negative news hitting pharmaceuticals this week. Those stocks like Eli Lilly getting absolutely crushed. This is not a chart that's getting crushed. To the contrary, it looks more like a technology name pushing above the 200-day. I think that's a nice breakout with further upside to be had. I'm looking at a retest of the October 2024 highs. All right, let's take some questions here, and I appreciate so much. Let's see. James, thanks for watching on YouTube. Yesterday, the DeGraff thrust was triggered. Add that with the Zweig thrust, which is already triggered. When both are triggered, returns are decidedly strong 6 to 12 months forward. Really cool news. I actually saw Jeff DeGraff in San Francisco not too long ago, invited him to come on the podcast, just exchanged emails with him earlier this week, got him on the calendar, and we'll talk about the DeGraff thrust, among many other things. I can't for the life of me remember when that's on the calendar, but I'm pretty sure it's on there. Let's see. I think it's next. It might be the beginning of June when I'm going to have him on, because we've got the next couple weeks laid out pretty well. But we'll have Jeff on the podcast. Jeff's awesome. I followed Jeff's work back to his Lehman years when he ran the technical research department there. He now runs his own shop called Renaissance Macro. Great market historian, great at linking the technical indicators and breadth indicators with all the other macro and policy themes. So it should be a lot of fun sort of picking his brain. For everything I just said, I'm not super familiar with Jeff's version of the breadth thrust. As I mentioned when I talked about the Zweig breadth thrust, there are many different examples or different types of ways we can look for breadth. And the general idea of a breadth thrust is it's very negative and it goes very positive in a short period of time. I'll look into that for sure and report back with more information on that. But actually having Jeff on the podcast here pretty soon, that should be a lot of fun. Let's see. David, you say, Dave, there appears to always be a bearish current underneath any positive bullish comments, kind of like a backhanded compliment, not a criticism, but an observation. Hey, you're not wrong, David. I would agree with it. And, it's so funny. I was just talking to someone about this and I forget who it was. And that is definitely something that underlies my process. The fact that I've been in the industry from 2000 to 2025, which overall has generally been a pretty great time to invest. But again, the first half of my career was pretty challenging with 9/11, with unwind of the tech bubble, with the great financial crisis. The teens into the 20s has been a much more bullish phase for sure. And I'm super happy as long as that continues. I think it probably has to do with when you started the industry. I don't know when you started investing, but I bet that when you learned about the markets, when you learned about charts, whatever the conditions were there, I would argue my thesis on this, which I've validated with many financial professionals. Whenever you started in the industry, that clouds your thinking, and it is so hard to get away from that bias. I started in the industry in 2000. I learned about investing when the tech bubble was over, and everyone was telling me how easy it was and how tech stocks would keep going up. And I worked with a bunch of people who got it all right and recognized all the signs that things were getting worse. And so for me, that has served me incredibly well at major tops. I tend to get tops really well because I identify the patterns. And going into, I mean, if you look back on this show, I'm sure November, December, January, we're talking a lot about markets being overextended, about concerning breadth, divergences, all these things. Market top check was totally fine. Bottoms are much tougher for me because, again, I've experienced a lot of bearish trends, and that's sort of my default, is looking for signs of concern. And the other reason I would say why I probably do that, most investors are generically bullish, right? They default to a bullish outlook. So I feel like me going on and just telling you how things are great and cheerleading what you're already doing, that feels a lot like confirmation bias to me. If you think about the real purpose of this the show, in terms of how I think of it, it's to challenge your thinking. It's to get you a little bit out of your comfort zone and just sort of question your thesis. And if what I'm doing and telling you things maybe are going to go down and it reinforces your position to do well, I feel like that's kind of a success. I'll take it. But for me, a lot of my time has been spent at shops where you challenge each other's thinking, where you force someone to take the alternate point of view. You have bull bear debates. So if we're all bullish all the time, that's pretty boring, to be honest with you. And so, yeah, I like to take the other side of things. And so as a result, I find I am often take more of a questioned perspective on the evidence, and I look for signs that things are a little negative. So I'm not surprised you pick up on that. One of my analysts at Fidelity, by the way, Mark Dibble, started the industry in 1982, and you better believe he was pretty much always bullish and usually right, because he started in the industry when that was what you needed to do. Joe, thanks for watching on YouTube. You said bearish island reversal on IWM. Thoughts? Let's look at what you're talking about. Oh, I see. Yeah. So if you're saying island reversal, you're saying zoom way in and maybe even look at like an hourly chart as where the island reversal is going to kind of come up. So you're talking about like this right here. So, I mean, maybe, right? So what you have to remember is an island reversal is one of those price patterns where it combines a number of, it has a couple pieces, right? The way that you make an island is two parts. Number one, you have a gap higher, a clear gap higher. But then you also have to have a clear gap lower. And this is not enough of a gap lower for me to say, yeah, that's an island. I mean, it's just this little bit here. So the way it creates an island top is you have a gap, you have a bunch of stuff, and then you have another gap down. And that creates that sort of island. Think of it like you're looking overhead at a map and you have this little land that's separated from the rest of it. An island top is usually pretty bearish, because what that means is we gapped up, we have this other stuff, and then we gapped down. And those two gaps, which create the island, are really the negative sign, because what you think about it is that's an exhaustion gap on the way out and on the way up, an exhaustion of buyers. And I think that choppy sideways island sort of reinforces that there's not a lot of buying power. It's just more consolidation. Then the gap lower is like an initiation gap, or we call a breakaway gap on the way down. And so those two gaps are what do it. So if you would have a gap down like tomorrow or next week, then it definitely could be an island reversal top. Too early to be able to determine whether or not that's actually going to be the case. I do want to let you know, as we bring up the disclaimer and wrap the show, I neglected to mention yesterday, and thanks so much, Tony, for the super chat on YouTube. I really appreciate it. I don't promote that a whole lot, but I really appreciate you guys if you're watching on YouTube, giving a nod and appreciation for the show means a lot, and I appreciate it so much. So thanks, Tony, for throwing that in yesterday. I meant to mention that, and I realized I did not. So apologize for that. But thank you again for watching, as always. That'll do it for today's episode, folks. Thanks so much for watching the show. Would love your questions, love your feedback as we go. We'll do an all mailback episode on Friday. We'd love to answer your questions there. In the meantime, have a great evening, and remember, it's always a good time to own good charts. Take care, folks.